What if I told you could collect a roughly 7% dividend yield right now, nearly 4 times what you'd get from the average S&P 500 stock? What if I told you this isn't some risky junk bond or sketchy investment scheme, but a fundamentally sound and strong stock that our AI-powered rating system ranks in the top 2% of all equities we track? Today, I'm revealing 2 dividend stocks that could start putting serious passive income in your pocket. One pays a respectable 3% yield and is trading at a big discount after 16 consecutive earnings beats. The other is a hidden gem paying nearly 7% that most investors have never heard of. I want to get right to it, sharing these tickers with you, and after that, I'll provide a little more context on why I'm looking at dividend stocks right now, and why right now is such a crucial time for dividend stock investing. But first, who am I and why should you even listen to me? Well, my name is Reitmeister, and I've been investing for over 40 years. I was previously the editor-in-chief of Zacks.com, where I educated millions of investors. Now I'm a partner at WallStreetZen.com, where I developed a quant rating system to help investors find the best stocks fast without all the noise and nonsense. By the way, I'm still pretty new to YouTube. Let me know if you like this topic by clicking like down below. Thanks so much for that. Now on to those 2 stocks. First up, we're going to talk about Macy's with the symbol of M. Yes, the department store chain. And before you roll your eyes thinking about struggling retail and the difficulties Macy's had, please hear me out. Macy's has beaten earnings estimates for 16 consecutive quarters. Yes, 16. Why? A few good reasons. Analysts set very low expectations for the struggling company. Gladly, management surpassed that low bar through aggressive cost cuts, store closures, and stronger than expected performance for their higher margin brands like Bloomingdale's and Blue Mercy. The most recent beat came on December 3rd, and despite those impressive results, the stock has actually dropped over 9% in the past month. This is what you call a buying opportunity. The market is handing you a chance to get into an improving dividend-paying stock at a discount. Right now, Macy's shares ranks in the top 3% of all the stocks we track. It's also the number 1 ranked stock in the department store industry, which itself has an industry rating of A according to our quant system. So what makes it so attractive? Let's start with valuation. Macy's ranks in the top 2% of all stocks for our value rating. But it's not just cheap, it's also growing. Macy ranks in the 77th percentile for growth. That's impressive considering earnings in the department stores industry are generally shrinking. This company is managing to expand when its competitors are actually struggling. Now, let's talk about that dividend. Macy's currently offers a forward dividend yield of 3.05%, and with a payout ratio of 41.4%, that dividend looks very stable and is likely to increase as profitability improves. As for the 16 straight beats, that tells me this management team knows how to execute, and the recent price pullback after more good news is an exciting buy-the-dip opportunity. The risks to consider with Macy's, well, retail is always vulnerable to economic slowdowns and changing consumer behavior. Department stores in particular face ongoing challenges from e-commerce competition. If the economy weakens, well, discretionary spending would take a hit. But with that solid dividend, attractive valuation, and consistent earnings performance, I think the risk-reward is tilted strongly in our favor here. Quick pause. If you like this video and want more like it, be sure to hit subscribe. That way, you'll gain access to the next round of stocks I talk about in the future. Now, for that second stock, it's Cohen Co with a symbol of COHN. And let me be real, we're going completely off the beaten path here. This is a pretty unorthodox pick for a video about dividend stocks, which are usually all about stability. But hear me out. Cohen is a Nano-Cap stock with a market cap of only $36.3 million. Yes, you heard me right. This is currently a very tiny company. But don't let that size fool you. This stock ranks in the top 2% of all equities we track. Cohen Co is a capital markets firm where they provide advisory services, manage capital, engage in principal investing. I know that sounds kind of generic, but stay with me because the numbers tell you a very compelling story. Here's why things are getting really interesting with the stock. The stock recently dropped 31%. Sounds scary, right? But here's the thing. This wasn't because of bad news. It was because the company paid a one-time special $2 per share dividend. This has some investors rushing to capitalize. Then they sold their shares. Now the dust is settling. As I'm recording this, the stock is starting to bounce back and believe there's plenty more room for us to get on board and enjoy more upside. Digging in, let's talk about that attractive dividend yield near 7%. That's nearly double what you're getting from Macy's and almost 4 times the S&P 500 average. But with a payout ratio ratio of 41.2%, the dividend looks very sustainable. Now, the valuation story gets even better. The stock trades for PE of just 7.3 times earnings. And here's the kicker. It has a PEG ratio, right? Price to earnings growth ratio of only 0.15. For context, anything under 1 is considered undervalued relative to its growth prospects. Only 0.15. This stock is absurdly cheap given how fast its earnings are growing. The numbers back this up. Cohen Co ranks in the top 8% for value and top 6% for growth. Plus, the balance sheet is solid. It's in the 83rd percentile for our financials rating, looking at 26 different measures of financial strength. But I need to be straight with you. There are risks here. This is a small, little-known stock with very limited Wall Street coverage. That means liquidity is quite low. Getting in and out of positions could be a bit challenging, especially if you take on a sizable position. The small market cap also means higher volatility, as in the stock can move more dramatically on a day-to-day basis relatively because of the small volume. That said, our system has identified really strong fundamentals here that the broad market hasn't caught on to yet. This is our chance to get in before everyone else wises up. My recommendation, if you decide to take a position in Cohen, then consider a smaller than usual allocation given the speculative nature of the shares. Putting it all together, the combination of an attractive valuation, strong growth prospects, and a really impressive 7% dividend yield makes this worth serious consideration for income-focused investors who can handle a little extra volatility. By the way, I use the same rating system to find these stocks to also find several more high-potential stocks I believe could double or more in the next year. You can get these 3 impressive stock picks for free, either by scanning the QR code or by clicking the link in the description below. So, those are the 2 dividend stocks. What do you think? Please leave a comment below and let me know if you're interested in either one of these tickers. I'm generally interested in what you have to say about these stocks. Earlier, I said I'd give you a little bit more context on why dividend stocks are so appealing right now and how I found these 2 stocks. Plain and simple, dividend stocks do much better when the Fed lowers rates. And it is clear that they are on a rate-cutting path that started in 2025 and likely will continue into the future. So this is prime time for high dividend-paying stocks. However, I'm not interested in the average dividend stock. I want to find the best ones that should both increase future dividend payments and see an increase in the share price. That leads to how I found today's stock picks by using our income stock strategy. This is just one of the 11 different market-beating strategies we offer in our Zen strategy service. Each strategy contains just 7 carefully selected stocks that are updated daily based on our 115-factor quant analysis review. Our income strategy has averaged a 24.9% per year return going all the way back to 2003 and is out of the gate strongly once again in 2026. But maybe income isn't your only focus right now. Maybe you're also interested in growth stocks or momentum plays or small caps. We have strategies for all those and more, including our coveted AI factor portfolio that's averaged a 47.4% gain per year going all the way back 20 years. To learn more about all 11 of our market-beating strategies, just scan the QR code or check out the Zen Strategies link below. And if you like this video, then please continue your investment journey with 2 more stock picks from another one of my market-beating portfolios.